समझ नहीं आ रहा अपने सैलरी इंक्रीमेंट का क्या करूं।
बेटा इतना क्या सोच रहा है? अपने म्यूचुअल फंड्स के एसआईपी का टॉप अप करा ले। दिस इज द राइट टाइम।
क्या? समझ में नहीं आया।
बेटा इतना क्या सोच रहा है? अपने म्यूचुअल फंड्स का एसआईपी टॉपअप करा ले। दिस इज द राइट टाइम।
अब समझा।
Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.
We shift our gaze from the Middle East and Iran today and look eastwards because there is a lot more to the world. And eastwards, we look at China. The reason we do that is that the Chinese premier, Li Qiang, has produced the 5-year plan, the new 5-year plan, to his National People's Congress or their parliament in the Great Hall of People in Beijing. And in that projection, for the first time since 1991, for the first time, China has projected an economic growth of less than 5%. They say 4.5 to 5, which in Chinese terms or with Chinese characteristics would mean something like 3.5 to 4. Last year, they claimed for the past 3 years, they've been claiming that they are setting the target for about 5%, and they've been claiming that they've been getting 5%. International experts are skeptical. They would usually think that this is closer to 4%, a little over 4%, not below 4%, but thereabouts, a little over 4%, but not quite 5%. Nevertheless, even if it's 5%, this year the projection is even less, which is quite remarkable for China. Because see this chart, first chart, I will share a bunch of charts with you. See this graphic, for example. On this graphic, you can see the China's growth. It has not remained on one plateau. At the same time, it has generally stayed above 10%. The average is in 2 digits. Since 1985-86, that's when Deng Xiaoping's reform started. So even in the first year, 1986, it's gone nearly 14%, well above 13%. Then the next couple of years, it has remained between 12 and 11.5%. Then it has fallen a little bit, early 90s, and again gone up. And there you see 2 Mount Kilimanjaros. The reason I use the African peak as my metaphor here is simply because these 2 rise sort of abruptly like Mount Kilimanjaro. Unlike any of the Himalayan mountains, Himalayas are a continuous range. You see those are upwards of 14%. So 2 years, say 1993 and 2008, Chinese growth has gone above 14%, about 14.2 to 14.3%. That is the average growth that China got used to, and that's how China suddenly left India behind, and the gap kept on widening. So when the Chinese say the growth is declining, this is no cause for celebration for India. It's also no cause for celebration in the rest of the world, because everybody in the world wants all economies to grow, because China, India, US, Europe, these are major economies, and what happens to them affects global economies. In India, for comparisons, our economy this year, IMF assesses, will be about $4.58 trillion. $4.58 trillion. You take 7% growth on that, that will be about $320 billion at 7%. Chinese, on the other hand, even if they grow at 4.5%, with a 20.7 trillion GDP expected by IMF in the same year, 2026, they would have added $1 trillion worth, nearly $1 trillion worth of value to their economy. So even at a lower growth rate, they would have added about 3.5 times of what India would add at a higher growth rate. I'm mentioning this not so that we feel bad. 7% growth is very good for a large economy like India. I'm just giving it to you for comparisons, because there was a time in 2008-9 that for 1 year, India's economic growth was higher than China's, and everybody started celebrating, and people then started saying, "Hum bhi hai, China and India will drive global growth and global economy." The gap was very large. The gap has only become larger since then. So we need a dose of realism when we deal with this. And since we are basing all of this on Chinese government data, I'm also sharing with you this graphic from Global Times that tells you the targets that the Chinese government has set in this 5-year plan for this year and going ahead. Look at Chinese growth and look at what has happened to Chinese growth in last 5 years. Only 1 year Chinese growth has gone above 8%. And that is the year after COVID. Even in the COVID year, the Chinese got some growth, 2%. India got a huge negative growth in that year, but Chinese got about 2%. Year after that, they got about 8%. Since then, they've been struggling. Last 3 years, as I told you earlier, they've been projecting 5% and claiming that they are meeting it. Nobody quite believes it. This year, they have lowered it. What is it that they are targeting? They say that they are targeting becoming a middle income developed country by 2035. What is a middle income developed country? China is still a middle income country on the upper side of the middle income. Chinese per capita income in 2026, according to IMF, will be upwards of $14,000. India's will be just a little over $3,000. Once again, for comparisons, China is almost 5 times India on per capita basis and 4.7, 4.8 times on nominal GDP basis. That said, for the Chinese to get their average incomes or average GDP or per capita GDP to 20,000 per person, that is the definition that the World Bank set up in 2020 for a developed country, for Viksit China or Viksit Bharat as envisaged for 2047. A Viksit nation, a developed country, a developed population, according to World Bank, the yardstick they set in 2020 was a per capita average income of $20,000. If the Chinese grow at 4.17% on an average from now until 2035, they don't want to do anything that destabilizes this momentum, even if they have a slowdown compared to the growth rates that they had got used to. Because China now faces a trap, which is called the middle income trap. Chinese population is getting older. I will give you some more data as we go along. China's burden of 60 years plus population is already 23% of their entire population. Globally, dependency ratio is set at 65, above 65 or below 65. That below 65 people earn, pay taxes, build things, buy things, and also provide for surpluses and taxes that go into the pensions and old age care for those above 65. That is called the dependency ratio. For China, it is rising. 23% Chinese are already above 60. China's average age at this point is 40.6 years for 2026. America, in comparison, is 38.4. In fact, if you see the projections for 2040 is when the Americans will get to 40.6 and the Chinese at that point will be 48 point something years per Chinese. So China is now getting old very rapidly, and that is what is inviting China into the middle income trap, because this population is not growing. There are no young people coming in. China is now seeing a decline in population. Last year, they saw a decline in population of 3.39 million people. That's almost 40 lakh people. And this decline is likely to continue. China, therefore, has got into a demographic trap of developed nations before quite becoming a developed nation. And that is the big concern for China. If you hear and if you read what Li Qiang said in his address to National People's Congress, he says that our big priority now is to increase consumption. The Chinese are not consuming because new families are not coming into the market. People are getting married later. People are producing babies later. If they're producing babies at all, they've already bought their basic necessities, even luxuries. As a consequence, the Chinese do not have consumption. What the Chinese need right now is the kind of thing that countries like ours are trying to fight. Chinese want that. What is that? That is inflation. The Chinese don't have inflation. This year, Li Qiang has said that he is optimistic that China will get 2% inflation. But all analysts tell you that's not possible. That's most unlikely, if not possible, because over the past many years, China has actually had a deflation. So if you see the GDP deflator, which is the amount, or that is the percentage that you net off against nominal growth, China has had negative inflation for the past many years. Can they turn the tide now? Looks tough, because look at the prices in China. Almost everything in China has become cheaper. Home prices 27%. You will see on this Bloomberg graphic, but I have read in lots of other coverage that in many urban areas it's gone up. It's gone up to, the fall in prices has gone up to 31, 32%. From 32%, which is housing in many urban areas, to 8%, which is say for tomatoes. Fruits have gone down from 30% to 15%. All of the essential goods, appliances, meats, processed foods, beverages, even wine, everything is declining. Prices of everything are declining because people are not consuming enough, or there are simply not enough new people coming in to consume. And that is what the Chinese have tried to address by becoming an even bigger export house or export power than they've been so far. There's a quote from Li Qiang, which I'll repeat for you. And I quote from him: geopolitical risks are rising, global economic momentum stays sluggish, while multilateralism and free trade are under severe threat. So his big threat is free trade is declining. Americans have woken up to it. Europeans have woken up to it. Europeans also want the Made in Europe label. And the era when Chinese could vacuum clean all of the manufacturing from all over the world, it's not yet over. The Chinese are very strong yet. In fact, this year, Chinese have had their highest trade surplus ever of $1.2 trillion. That's more than India's entire exports, in fact. And that is something that Europe has noted, India has noted, but India will not do very much about it because India has to keep its relationship with China calm. And most of what India is importing from China is what India needs right now. Think of the famous BYD car, for example. In China, the price has fallen by 27%. No wonder then the Chinese manufacturers find it more profitable to sell it overseas with a markup over this, and still at a price which is very much lower than a Tesla can sell at anywhere in the world or any other competitor of BYD. Li Qiang also acknowledged that the property market in China has seen a deep downturn. I'm quoting from him. It's in a period of adjustment, he said, the property market, where the imbalance between strong supply and weak demand is acute. So he's using diplomatic language, but once again, it's the same point. We have data from National Bureau of Statistics and the Bloomberg chart based on that data that tells you how China's property prices have been declining, although the government has done many things to shore them up, including what is called as 3 red lines policy that was introduced in 2021 or so. But there is nothing to stop the relentless fall of home prices. It's a developed country demographic trap before you become a developed country, even on the lower side, which is $20,000 per capita income. Li Qiang also said, and I quote from him, it's become more challenging for people to secure jobs and to earn more. The 5-year plan, it says, is now aimed at global tech superiority. The Chinese economy is remarkably resilient, and China must diversify exports and invest more in R&D. R&D means China now wants to build entire chip supply chains in China and give up its dependence on US and Taiwan, and to some extent on Japan. They want to build AI computing clusters and data centers. That is what India is also trying to do right now. What do countries do when they want more growth but are not getting it? Or when they are not getting the inflation? Japanese have faced this problem for a very long time. They print more money and they distribute it. Can the Chinese do it? The Chinese have a problem. And I will share with you Ruchir Sharma's column from earlier this year, when he makes his predictions for the year, when he predicts trends for the year, and see the section on China, that's on your screens. And he tells you that the Chinese, given their debt to GDP, their debt including household debt to GDP is now upwards of 300%. And then I'm adding to that, the Chinese deficit is already upwards of 4%, whereas their target is 3%. It's not likely, in fact, it's nearly impossible that they will start printing more money to release more of it to their population in the market to bring in some inflation and thereby some more growth and buying capacity. They are not going to do it because they don't want people to be borrowing more. That's another trap. You don't want people to borrow more. At the same time, you want people to buy more. That's a paradox, and I know questions will again arise about the India comparison. In India, debt to GDP ratio, including household debt, is 120%. Yet, Li Qiang says optimistically that he's targeting a notable rise in consumption as a share of GDP. It's the first time that the Chinese have said it, which means they are acknowledging troubles with their economy. Again, no comfort for India. This is a China-specific problem. The target they have set is the lowest since the 90s. The growth that they will get with this target this year will be the lowest in 3 decades, except 2020, the COVID year, when it was just over 2%. And even this is being achieved only because of this trade surplus. Surplus, as I told you earlier, is $1.2 trillion. 10% of this, about 10% of which comes from India. And that's one of the reasons, in fact, I would say one of the primary reasons that the Chinese have restored stability with India along the line of actual control, because they really need this trade surplus. And that's also the reason that I think the Modi government has let it be, because it's not as if government of India is importing this. This is what Indian industry needs. This is what Indian consumers need until Indian manufacturing can compete. And they are letting this come in, and that builds a vested interest for China to keep stability in its ties with India. Now I come to the next chart, and some of these charts are from Bloomberg, which is an agency we subscribe to. This is a story we published also, and this graphic is from there. This tells you how China's exports are rising and how export dependent China's growth has become. In fact, in the same column, Ruchir Sharma, where he predicts the trends for 2026, says that China's economic crisis has two masks. One mask is that Chinese stock markets have gone up this year, last year, in spite of the fact that for a long time they were seen as uninvestable. They were not growing, and that's happened because of AI. So AI-led growth is the one mask. The other mask is China's export growth. If you see this graphic, this tells you China's exports have been rising sort of relentlessly since 2001, where this graphic starts. Now they've crossed the $4 trillion mark. They've come to about $4 trillion. The imports had been rising, but they've been stable. In fact, if anything, they've declined a little bit over the last 3-4 years. Imports are about $2.8 trillion, and that's what gives you a surplus, what gives the Chinese a surplus of $1.2 trillion. The bars is also focus on the bars that you see on this graphic. Bars that go up like this. These bars show you that China's trade surplus has been rising every year since 2018. Every year. While other areas of the economy slowed down, it is the export surpluses, right? Rising export surpluses that have given China the tailwinds, except 17 and 18, 2017-18, when the Chinese export surplus had some kind of a stall and reduced to $500 billion, about $500 billion. That's a loss of money. That's a lot of money. Otherwise, Chinese export surpluses have been rising, and that is the reason it's so critical for China to continue on with this, because their economy at this point does not have a domestic consumption or investment story. Now we come to the population graphic. See it on your screen, again from Bloomberg. See the Chinese birth rates or births per million. These are not percentages, these are per million. Chinese births per million have been declining. They were stable for some time. Around 2015, there was a little bit of a bump up. I think that's around time they lifted. About 2010-11, they lifted their one-child policy. So you can see a little bit of a tiny bump up, like a pimple, and then it comes right back and it starts falling. As average incomes rise in China, birth rates start falling, and then somewhere around 2022-23, the two lines cross. The line that's been coming down is the line of births per million. The line that's been going up gently is deaths per million. In 2022-23, the two lines cross, which means for the past 4 years now, the Chinese have added fewer babies to their population than the people they've lost to death. And that's how the Chinese population has been declining. At this point, it's just about 1.39 something billion. It was 141 billion at its peak. For the past 4 years, China has had negative population growth. And as time passes now, this negative population growth, the figure will become larger. The percentage will become larger. That's why China is aging so fast now. I know the question will come up. For comparison, India's debt to GDP ratio, including household debt, is 120%. It's still steep given India's economy, the size of India's economy, and the fragility of a lot of India's population. It's also significant that India's household debt has actually gone up. It's gone up in 2025 to 41.3% of the GDP as compared to the average for the preceding 5 years of 38.3% of national GDP. So household debt in India is going up. And finally, having talked about China and the struggles they are having right now sustaining their growth rates, because once you get used to running at a certain pace, slowing down and getting used to it becomes a problem. We've had Christopher Landau, the American Deputy Secretary of State, speaking at Raisina Dialogues, saying something really breathtaking. He said, and I'm paraphrasing him, that we made a mistake once. I'm paraphrasing it. I'm paraphrasing it and giving you the meaning of what he said. We made a mistake helping China grow and become a challenger to us. We will not help India grow like that. So we will not repeat that mistake. I'm surprised that at a think tank in Delhi, nobody stood up and said, you're talking nonsense, because this is an insult to China, of course. It's also an insult to India. The Chinese grew because of their own entrepreneurship, because of their own policies, because of their own focus, because they invested in their human capital and they resolved a lot of their basic issues. Electricity, for example. The Chinese did not grow because the Americans helped them to grow. If anything, the Chinese produced cheap goods. The Chinese also allowed Western brands to shift there for cheaper manufacture so they could compete better across the world and sell more across the world. The Chinese growth story or the Chinese economic success was not at the cost of the West and definitely not at the cost of the US, and most certainly not because of some charity from the US. Similarly, if India has to grow, we should not be heartbroken that, oh, this American has said they will not help India grow as they made China grow. They did not make China grow. I'm giving you opinion. They cannot make India grow. And if India remains focused, India reforms its economy further, India does all the right things, keeps its social cohesion. Even if the Americans wanted to stop India growing, they will not be able to stop India growing. I'm not saying that they want to stop India growing, but the notion that they would have helped India grow and now they are saying they will not help India grow is pure poppycock. And for somebody from US government to sit and say this in New Delhi in front of many smart people tells you how the world of Donald Trump thinks about the rest of the world.